Welcome to SilverOak's quarterly webinar. The webinar is scheduled to last 45 to 60 minutes, and a copy of the webinar is going to be posted to our SilverOak website afterwards. That's typical, and I guess I should probably introduce myself as well. So my name is Shannon King. I am president and partner, as well as chief compliance officer for SilverOak. And with me today, as usual, is Jonathan Charlo, also a partner and our lead analyst. As we go through today's webinar, if you have any questions, please feel free to contact your SilverOak advisor after the session. If you're not currently working with a SilverOak advisor, you can contact me directly at 952-896-5701. And of course, I want to thank Jonathan and the rest of the entire team that's been involved in putting together today's webinar. It really does take a village to get all of this coordinated in a timely fashion, including on the technology side, not just what people are going to see on the screen. So thank you for everybody's involvement there. For compliance purposes, I must note that we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, quarterly performance reports that have been customized for each client have been sent out and hopefully have been received by all of our clients. If you've got any questions on those reports, please contact your SilverOak advisor if they've not already contacted you. And lastly, past performance is no guarantee of future success. So Jonathan, let's take a look at the agenda today. We're going to start with the economy and talking about the SilverOak dashboard. Then we're going to go into a discussion around market performance for the third quarter. Then we'll talk about SilverOak's outlook moving forward from the third quarter. We have a few SilverOak updates and miscellaneous other items to provide, and a brief discussion on estate and gift planning. And of course, if you have any questions, or even if any of the participants today have suggestions on new topics for future webinars, I encourage you to reach out to your advisor or to me directly. So where are we with the economy, Jonathan?
Well, the economy continues to moderate. So a lot of the things like inflation are coming down. The Federal Reserve is starting to lower interest rates, but still it's very solid and seems to be stable. And we're going to, I think, see that when we look at the dashboard and components of the dashboard.
So let's jump to that. And for those that are new to our webinars, we break the dashboard out into 4 components. We'll start with the economy, and actually the economy has 11 different sub-factors that we measure, but the economy is shown here first. Each of the columns is a different quarter going back to the third quarter of 2021. If the shaded area is green, that means it's positive. Gray is neutral and red is negative. So we can see we've pretty much been in that neutral category with the economy for the last couple of quarters, and we're projecting that to continue. Credit markets, the second of the 4 major components. And actually with the credit markets, there's 6 sub-factors that we measure. But as everyone can see, that has remained neutral for the last couple of quarters as well. And we're projecting that to remain neutral moving forward to the fourth quarter. Valuations also have remained consistent. Now, it's red here, Jonathan, and red signifies what?
The valuations are high.
Yes.
And we have definitely seen that in general certainly for the last 2 or 3 years.
And we'll talk about earnings, because earnings will justify high valuations potentially, but that's the question, will they?
Absolutely correct.
And then the fourth factor under the dashboard is the market sentiment. And there's, I think, 8 sub-factors, if I recall correctly, to that particular component. And like with the other 3 components, it's remained consistent in the positive category, and we don't see a change happening for the fourth quarter. Now, as we look at the composite itself and the 6-month average, you will see that we upgraded it from red to neutral. And you know, in full transparency, the economy as a whole has kind of been on that threshold. We could have had neutral last quarter. I mean, it's like within tenths of meeting that neutral factor. So it's been hovering between this negative and positive, or negative and neutral, for the last quarter or so. The key here, though, is the trajectory of the dashboard has definitely been on the upward slope, really bouncing off of what we saw from 2022. And not only has the dashboard obviously been on the upward slope, but you can see the blue line, that's the markets, the S&P 500, and that's corresponded as well. Anything else we should point out with regards to the dashboard, Jonathan?
Yeah, I think one of the things, you know, we're looking at in the dashboard are these improvements. We're going to have to look, we'll probably talk about this more next quarter on the economy, but where we're going from here, because the market has done so well.
Yeah, so we're looking to make a few adjustments to the dashboard based on some things that we're seeing. They're just a little different this time. All right, let's go to components of the dashboard then. And we'll start with one component of the economy, and that is the ISM, manufacturing index.
Yeah, so it has been below the 50 line, which is in red. It had been ticking up. It's come down a little bit. And so the thing we though have to remember, and we get into this later, is that the consumer part of the economy is much bigger factor, and it's been stronger. And so despite the weakness we're seeing in manufacturing, the overall economy has been pretty stable.
Another big component of the economy as it relates to the dashboard is the unemployment rate.
Yeah, and so we have seen the labor markets moderate, and so we've seen a tick up in the overall unemployment rate, but we did actually in the last month see that come down. And that is going to play a factor, I think, with the Federal Reserve and interest rate cuts going forward, because they've noted that they're more concerned about the labor market. But then last month, the numbers were stronger than people were anticipating.
And when you say more concerned, everybody should remember that the Federal Reserve has a dual mandate. So our Federal Reserve, unlike some across the globe, ours has a dual mandate. One is stable price, and the other is full employment. So the last year or two, they've been really focused on stable price, i.e. inflation, trying to get inflation down. Now they've signified that they're shifting kind of their major concern from the inflation, as you just mentioned, more to the labor markets, the full employment component. Although I would argue, I mean, still 4% unemployment, still kind of, I mean, look at history, that's right. Still, it's pretty full employment. I mean, I think it used to be considered like 6% unemployment was considered full employment.
Yeah, absolutely.
So 4.2, 4.3, I mean, it's still pretty good. Of course, not for the 4.2 or 4.3 that are unemployed, but.
True. So also then looking at the economy, housing starts. housing starts had a nice rebound coming out of the pandemic and have been coming down. And I think that's more interest rate related. And they did come down in the last quarter. Now, I think, you know, there's the hope that with interest rates coming down, we'll see mortgage rates coming down. But I think another little factor that we might want to watch is that the multifamily buildings, so apartments and things like that, have been very strong over the last couple of years. And I think those are starting to slow down a little bit. So now we look at kind of the credit markets part of the dashboard, and one of the components is the yield curve. And we've talked about this for a number of quarters, that essentially it's been inverted. Now, one of the measures has actually become uninverted, meaning now it has a slightly positive slope, and that would be the 10-year versus the 2-year. What's still inverted is really what the Fed watches more closely, which is the Fed's funds rate versus the 10-year. That's still inverted because the Fed is only at the beginning of what looks to be a cutting cycle.
And why do we care about inversions?
Well, typically in the past, what it meant was that we had very easy credit terms, and then we were trying to tighten them up. Ultimately just to try to slow inflation or kind of slow the economy a little bit. I think the issue that we're dealing with right now is that the Fed has had so many other tools that it's used other than just interest rates. And so I don't think we're looking at apples to apples anymore.
Right. Yeah, and on this chart, you can see a lot of the inversions then were followed by recessions. And I think that's what everybody got spooked with when it first inverted. Is like, oh my goodness, is this the sign the bond market's telling us there's a recession coming? And we've obviously avoided that and could very well be in that soft landing scenario.
Correct. Yeah.
All right. High yield spreads.
Yeah, so this is another one we've been tracking, and this has also been puzzling for people, which is that with the economy moderating, we probably should be seeing higher yield spreads widening. But we haven't. We've actually seen them stay very narrow. And so in some respects, that's telling us that the risk of a recession certainly isn't within sight.
And again, just for those that aren't on the webinar in past sessions, that spread, when it widens, right, that means a lot of risk in the market. Probably a lot of defaults are happening, companies going out of business, etc. When it's really tight, conditions are pretty moderate.
Right. So investors are basically looking at that less than investment grade company and saying, yes, we think there's more risk, and so I want more yield to compensate for that.
And that creates that spread.
And that creates that spread. But what we've seen is actually the opposite.
Yeah. But again, the economy's doing relatively well. I mean, moderating, as you mentioned, but moderating off of pretty good numbers anyway.
Yeah, absolutely. And so getting to the dashboard on valuation, which has been red, so, you know, highly valued, and that's been an issue for the last couple of years. We are projecting that earnings growth will get better. We go into greater detail later, but one of the bright spots has been technology in the Mag 7. What we really need to see going forward, hopefully a little bit this quarter, but more importantly in the fourth quarter, is that we see the other 493 companies in the S&P show some meaningful earnings growth.
Yeah. And of all the slides, this might, in my opinion, be one of the more important, because again, earnings will either justify the valuations or those valuations are going to have to shift down.
And then finally, sentiment in the model. We've just been basically showing you the market trend, and the market trend is strong. There is strong momentum. It's continued. So now we're at that point what is the next act for the market? And that's why we're suggesting earnings is so important going forward.
So let's talk about the markets. And maybe this touches a little bit on that valuation discussion that we just had, because you're going to see some of these numbers are really pretty astonishing. Right now, we're just showing the third quarter numbers. So these are just literally 3 months of performance data, with the S&P 500 up almost 6%, Russell mid cap, Russell small cap up more than 9%. International stocks did really well. Now, we added some information here. We added the MSCI ACWI ex-US net return local performance. And you'll see the local performance in emerging markets as well. What does that mean? That's basically the performance in local currency terms before it gets converted to US dollars. What's interesting here is for the last, I don't know, couple years, the dollar has been very strong, especially kind of at the beginning of this year. Dollar was hitting like 10, 20-year highs. But for the quarter, the dollar, I mean, literally, if we started the third quarter, that was almost the peak of the US dollar. And June 30th, or excuse me, September 30th was almost the bottom, because actually since the end of the quarter, the dollar started to strengthen again. But I found that funny as soon as we added that data. As far as for the year to date, again, double-digit returns across the board, and we're not even to the end of the year. So very, very strong performance. And when we talk about the S&P 500, you had made reference before we started today's webinar that if we took out the Mag 7, the S&P, how much would it be up year to date?
About 11 to 12%.
11 to 12. So kind of historical average, maybe a little bit higher, certainly higher if we annualized it. But boy, those Mag 7, they contribute a lot to that 22%.
Absolutely.
If we look at bonds, you can see for the quarter, really nice performance for the quarter. US Ag up 5, some of the global sectors up even more. Again, that weakening dollar for the quarter helped improve some of the global fixed income performance numbers. Solid numbers year to date as well, though. Obviously, the quarter was super strong, so helped the year to date numbers from where they started. Let's talk about the value growth discussion, because I mentioned the Mag 7. Obviously, that's all growth oriented, but for the third quarter, that really didn't perform as well.
Yeah, so actually in the month of September, a number of the Mag 7 stocks were actually down during the month. But the other side of that was that kind of everything else was actually up. And so that translated actually in large, mid, and small to, in the third quarter, to stronger performance by value than growth. Now, that doesn't hold true when we look at it on a year-to-date basis. Certainly large cap growth has done very, very well this year. But interestingly, when we look in the mid-cap area, mid-cap value on a year-to-date basis is actually slightly beating growth.
And in a few minutes, we'll talk a little bit about the makeup of large, mid, and small, and why large cap really has done so well based on the sector makeup of that particular category. So here's the S&P 500 and a little bit about the sector performance. We're showing here the third quarter performance. And this is really where we see that value orientation for the third quarter, because the sectors that did best are more value oriented.
Yeah, the one that didn't do well is energy. And certainly I think we've seen gas at the gas pump go down in price. The price of oil per barrel has gone down, despite what's kind of going on from a world event standpoint. I think that we've honestly had a decent amount of supply.
Sure. And we show year to date, obviously consistent message, right? For the quarter, value did well, value sectors did well with the exception of energy. But for the year, growth really has dominated in most cases.
Yeah, there's one industry I just wanted to pull out quickly on the utility side within value. We're going to talk a little later about the technology investing and how that's kind of transformed the economy, but that actually has hit the electricity market with the rise of data centers and what energy hogs they essentially are. So demand for electricity has come up, but I think from a stock perspective, people are anticipating further growth, and so we've seen a big pop in electric utility stocks.
So here, I made reference to this a few minutes ago. Here's the breakout of large, mid, and small caps. And there's some interesting dynamics to this, Jonathan. Why don't you walk us through those?
Yeah, so on the left, we're looking at the sector composition between large, mid, and small. I think the thing we've seen is strong large cap performance, and we've talked about the Mag 7. But the reality is that when we look at growth versus value in the S&P, 62% of the weighting is now growth versus value. When we look at mid-cap, though, interestingly, it flips the opposite direction, where value is roughly 2/3. And again, we mentioned that for the year-to-date period, mid-cap value is doing better than mid-cap growth, and I think that's why. When we look at small cap, it's kind of right in the middle, but still skews a bit more towards value than growth. Now, one of the things we did see was that small cap did a little bit better. It almost doubled the large cap return. And so I think one of the things that has hurt small caps over the last couple of years is how many unprofitable companies there are in small caps. So I did want to highlight that for you. And then this.
So this is saying, like, of the small cap market, 41% of those companies are unprofitable.
Yeah. But then the other way to look at it is the left one, the 4%, that's large cap. That tells you how high quality the S&P is, and largely because of the strong economic performance we've seen from the technology sector.
Got it.
Now, here we've talked a little bit about earnings, and I think for small caps to continue to improve, we're going to actually have to see those unprofitable companies start to earn money. And so the interesting thing is that for the last 5 quarters, including the third quarter, we have negative earnings growth on a year-over-year basis. In the fourth quarter, we're expecting, at least the market is expecting, a very large ramp in small cap earnings, up 20%.
Wow, from down 10.
Yes, and again, even looking at large cap, up 15%. So we had strong performance in the third quarter from kind of everything else. Now I think we actually need to see those earnings come through to really fuel the markets as we go into next year.
Right. Well, and talking about earnings, and I don't want to stress the importance or overstress the importance, but they are quite important as we look at valuations. Another place we'd like to see some earnings is from the international market. So let's talk about performance of international.
So international performance was good last quarter. And interestingly, China led the way. China had been weaker, but in mid-September, China did announce a very large stimulus package, large enough that it goes back to kind of levels we saw back in 2015. That kind of helped Asia, but in general, positive returns. Then when we look on a year-to-date basis, that strong showing in the third quarter for China kind of drove their markets on a year-to-date basis kind of to the top. The outlier to that is that Latin America has been relatively weak this year.
So we've talked a lot about equities in the stock markets. Let's transition to the bond market, and how did it do for the quarter?
We saw a very strong rebound during the third quarter, and so really across the board, we're looking at 4 or 5% returns. Municipals were a little bit lower. Now their yields are generally a bit lower anyway. But what we'll see when we kind of look at the year-to-date returns is that for some of the sectors, the third quarter is their year-to-date return. When we look to the left towards emerging markets and high yield, which are more credit oriented, they were actually stronger earlier in the year, and that's really why they lead the way.
So let's transition our discussion now to the outlook. And as we look forward, first from an economic perspective in the US, I had made reference to the soft landing. Still seems like maybe the most plausible outcome. I mean, nobody really knows. And I don't think the Fed is probably ever going, at least not in the next year or two, to declare victory. That would be maybe a little premature, but like we've said it several times, the economy's still chugging along and consumers are still spending. Retail yesterday, the numbers came out. I think, what was it, up 0.4%? I think we were expecting 0.3 and a little bit better than expectations. And frankly, Jonathan, you and I know, probably everybody else knows, as long as the consumer's spending, it's really, really hard to go into a recession because 2/3 of GDP is consumer spending. So inflation, likely to decline. Now, there is an argument that the last mile's the hardest, but nonetheless, it looks like hopefully we can avoid that scenario that we had in the 70s where we had inflation rear its ugly head a second time. We're hoping not to see that. And the Fed probably is going to continue to cut rates. I think it's kind of arguable from 1 week to the next. Is it going to be a 25-25 in November and December, or 50 and 25, or 25 and 50, or?
Yeah, it kind of honestly changes by the data point. Because 2 weeks ago, I think the market was almost certain that the next cut would also be 0.5%, but then the labor numbers came in strong.
Right.
So
yeah. Now retail came in strong. I've heard maybe no increase in November. I think the odds are still 25, but or decrease. I said increase, but decrease. So we'll see. International economy, geopolitical risk appears manageable, and I kind of hate saying that given all the conflict in the world right now, but the markets just seem to have overlooked everything that's happening. Several other global central banks have started cutting rates. You mentioned the easing in China that's happened, and of course India and Japan could continue to be kind of bright spots in the markets. So we really don't see a sign of recession, do we?
Right. So the National Bureau of Economic Research calls recessions. These are the 6 factors that they look at, and they need to see weakness, widespread weakness, I think is what they say, for several quarters. And so what we're looking at is still positive numbers. Now, some of them have come down and are almost near zero, but again, unless the Federal Reserve is behind the curve with interest rate cuts, it really looks like, again, the most plausible scenario is a soft landing where growth just slows but stays positive.
And it's not as though if one of these goes negative, they call a recession.
Right.
Typically, multiple of these have to go negative in order for them to call a recession. Now, I just mentioned the most recent consumer spending numbers. I mean, that just continues to amaze me, and I shouldn't be amazed because U.S. consumers, we like to spend money.
They kind of say the U.S. consumer spends until they can't.
Exactly.
So
I think that's what people have been fearful of, right? is all that stimulus money
Right.
has probably been spent. People are spending more on credit cards, driving up those. And at what point, to your comment, can they not spend anymore?
Right, and on the right, we look at the personal savings rate, and that's lower than certainly where it was during the pandemic. You know, and I think that is people who still think there's a recession risk. This is where they're looking.
Yeah, makes sense. Technology, going back to kind of the discussion around growth stocks. Technology spending really is a significant impact on the U.S. economy.
Yeah, so on the left, we're looking at the CapEx from the big tech companies. So the new term they use for this group of companies is hyperscalers. So essentially, they kind of scale the internet and consumers. And so they're spending a lot of money on data centers for AI. And so the interesting thing is it's been a nice ramp even before ChatGPT was announced in 2022, but you can clearly see the expectations are for continued strong spending. If we look on the right side, the interesting thing is if we look at industrial production, if you look at all industries, high technology, so that green line, it's pretty flat. It's really the technology, the semiconductors, the computer and communications equipment that is driving production.
Interesting. Yeah, we were talking before the webinar. It's just amazing how in just a relatively short period of time, nuclear
Yes.
was completely out. I mean, 9/11 happened and nuclear was basically shut down after 9/11 and concerns with security and safety and such. And now it's making this renaissance back to being the vogue form of energy.
Yeah, so Microsoft, just so you know what we're talking about, signed an agreement with the owner of 3 Mile Island, and they're going to restart one of the reactors.
Yeah.
They're going to buy that energy for their data centers. And then I think it was maybe Amazon or Google recently announced agreements to purchase power from new reactors that would be built that are actually kind of a little bit smaller than the traditional ones. And part of this is that, you know, technology companies have committed to utilizing clean energy.
Right.
And there's not enough of wind and solar at this point for them. So they really need another source.
So we mentioned inflation continues to decline. Anything you wanted to add to that?
Yeah, so the interesting thing is if we look at the headline PCE deflator in August, it was 2.2%. The reason I just point this out is that that's within sight of what the Fed is looking at. Now, of course, the core, and the core has been more sticky, is a bit higher. And I think there's a fear that if the Fed starts to cut rates too quickly, that we could see another kind of mini surge in inflation. So, but the overall trend is suggestive that we're coming down.
And then manufacturing. We talked about manufacturing once. Now this slide shows something a little bit different though.
Yeah, so here we're plotting the ISM PMI for services and the ISM PMI for manufacturing. And so you're actually looking on the far right, the services side has actually strengthened while we've seen the manufacturing weaken. And again, this gets back to 2/3 of our economy is consumer spending based. And so that's, I think, why we've seen the stability in the overall economy. Now, in the third quarter, we mentioned that value did better. And I think one of the things we saw was manufacturing stocks had a nice bounce. I think that's investors looking to an improvement at some point in the future. So the market is forward looking in that case.
All right, so let's talk about our outlook as it relates to the equity markets. And here we say we could see a pullback. I mean, we pretty much always say you could see a pullback. I mean, who knows?
And we thought last quarter we could see
Yes.
that.
Yeah, and it was as we saw earlier, a very, very strong quarter. But typically we at this stage would expect to see more volatility, and we've seen a little bit more, but not that much. Most of the volatility has been on the upside, not the downside. But we talked about the Mag 7 valuations are getting really high. Got to have those earnings to justify the current valuations. Of course, geopolitical wildcards are definitely at a heightened state right now. But pullbacks, when they happen, they shouldn't be things that scare people because it's normal, right? The markets tend to go up, they tend to go down. Long term, stocks tend to do nothing but make money. It just can be a little bit of a wild ride along the way. And sometimes you just have to hold on. Certainly, we have a more positive long-term outlook. There is a lot of momentum. Jonathan made reference to that. Performance tends to be, or looks to anyway, to be broadening. You had made reference to that as well. Valuation of equities outside those Magnificent Seven, not as expensive. Mentioned earnings. And in this early stage of AI, we talked about technology a couple of times in today's webinar. But back to earnings, this is the wild card. So show us or talk through what we're showing here.
Yeah, so basically we're looking at the fourth quarter. The Mag 7 earnings will still remain strong, but we're looking for all the other stocks, so 493 S&P companies showing 13% earnings growth in the fourth quarter from 0 this quarter and actually negative in the prior quarter.
So just to bring two slides together, earlier we talked about small caps going from -10 to +20. Here we're saying large caps are going to go from, or at least the S&P X Mag 7 going from 0 to +13.
Yeah, absolutely. And if we look on the bottom, one of the things, obviously we need to see revenue growth from the other 493 companies. But one of the things that, that has kind of hit them is with inflation. They initially raised prices, but margins have come down a bit. And so we need to see some margin recovery for the other stocks, I think, for those earnings to come through.
Got it. And how about ex-US when it relates to earnings?
Yeah, outside the US, Europe, Japan, emerging markets, good, strong earnings growth. Certainly, if you look at Europe, we are expecting a nice ramp for next year. EM, yes, it would come down from this year's number to next year, but that's still a very high number and would equal the US for next year.
The question that I would have is, on a risk-adjusted basis, are investors going to be willing to accept the emerging market earnings expectations relative to the US?
Right, because the US, we've had a nice solid trend in earnings. Yeah. EM has definitely been more volatile.
Yeah. And what we're showing here is equity returns as the Fed starts their rate cutting cycle. And of course, we're now at the beginning of that process. So what do we typically see, Jonathan?
Yeah, so the red is the 2024, kind of on the left. If you look on the top, you're looking at 1995, 2019, 1984, 1989, generally positive performance. We do have two instances, though, in 2007 and in 2001, where stocks were down following the beginning of a rate cut cycle. but that was because we were kind of already heading into recessions in those cases. And so when we kind of look at our current scenario, this really is important to kind of glean where the economy is heading. If the economy doesn't stall out and go into a mild recession, we're probably looking at pretty good equity returns.
And so at the far right on that left chart, that's 24 months after the start of the rate cut. So we're at the very, very beginning stage of this process.
Yep. And again, we've also then talked about how earnings growth is important. And so the interesting thing is that this might be one or the only Fed cutting cycle where earnings growth is expected to accelerate. Usually when the Fed is cutting, it's because we're already seeing weakness.
Got it. We touched on the dollar earlier, and as I made reference, the beginning of the quarter, the dollar probably was at its peak. The end of the quarter, it was probably at its trough, because this data is through 9/30. Really, since 9/30, the dollar has started to strengthen back again. But if the dollar were to weaken, or at least not get too strong, that could help propel international performance. And we say international is well positioned. Why would that be the case?
Well, as we were also saying, we've said that for a number of years. If we look on the left, we're looking at the price earnings ratio discount that the international markets have had to the US. And we're sitting at a differential of 36%. Now, that's not to say that parity is zero. International stocks typically are undervalued relative to the US, but it's normally, the average is about 17%. So, but this has been going on for a long time, admittedly. Now, on the right, one of the things, what we're looking at is this is showing the differential between dividend yield in the US versus international. And this is at a 1.7% premium. If you actually look at the current dividend yield, the S&P is at 1.4%, and the international dividend is at 3.1%. So again, a little more than double what we're seeing in the US.
So let's touch on the fixed income markets and our outlook there. We've mentioned the Fed started to lower their rates. They did 50 basis points in September, probably 25 in November and December. We'll see. Likely to cut more next year if things progress as expected. So that provides good environments for these bond investments. Now, having said that, cash yields are probably going to lower as the Fed continues to cut rates. So those folks that have money stashed off in, high yielding money markets or bank accounts or whatever it might be, those rates are going to start coming down, and those returns aren't going to look nearly as attractive. But we always believe, depending on a client's risk profile, that bonds can play an important role in a diversified portfolio. More for some investors that may be a little bit more risk adverse, maybe a little bit less for those that are willing to take a little bit more risk in the equity markets. But probably today bonds are probably as well positioned as they have been in the last at least several years.
Yeah, absolutely. So here we wanted to kind of talk about the positioning for bonds. So, the bond yield in a total return bond fund is right around that 4% range. If we look on the left, and we're in a scenario, again, where we don't have a recession, then we're looking at bond returns of almost 10% over the next 12 months. And this is going back to data to 1926. Now, US stocks would have a higher return, but I think—
Well, that's true, but not fair. I mean, that's like, I always say that's like comparing a Pinto to a Lamborghini. I mean, they're different
Yep.
utility of the two.
But when you think about what happened in 2022, this would be welcome news.
That's fair.
Now I think more importantly though is the situation on the right side. Now again, we are not saying that a recession is our base case. It's more plausible that it's a soft landing. But if there was a mild recession, we would likely see stocks go down. And that's what the data shows. But in most periods, bonds do provide that hedge against that equity downside. And so the average return after the first rate cut, and there is a recession within the 12 months, bond returns are about 8%.
Got it. Well, thank you for that information. Let's go through a couple of SilverOak updates, and then we're going to talk about estate and gift tax items as well. So SilverOak updates. Well, one, tax season is officially over, and a lot of people are probably like, well, you know what, you guys are like 6 months late because it was April 15th back, 6 months ago. Well, actually, if you extended your tax return, you had until October 15th to file. And so now that we're past October 15th, tax season is officially over for 2023. I am very pleased to say we have a new operations specialist on our team. So it's nice to see that the firm is continuing to grow, and we're adding fabulous team members. So we want to welcome all of our new team members. IQs, this is our investment quality scoring system. A couple of updates here. We added several new positions to our recommended list, including two interval funds. One is a private credit, and one is a municipal flexible strategy. Neither of these are positions that I'd say are cookie cutter positions that we put in all portfolios. They are particular based on circumstances, but it was nice to see that those were added. We did add one of our IQs positions to the watch list for performance reasons, and then we removed two from our recommended list, but it was not performance related on those two removals. It had more to do with lack of usage, and we could get similar strategies at a lower cost. So,
yeah. So basically, it was kind of a busy quarter.
It was a busy
from
quarter.
an IQ standpoint. When we, look at overall performance, what I would say is large cap definitely had strong absolute performance. I think on the margin, from a relative standpoint, value did a little bit better across our IQ's positions. The two areas that I'd say were a little bit more weak on a relative performance basis was small cap and emerging markets. And then when we look in the fixed income area, we did see strong rebounds among all of our funds in the third quarter, and generally pretty good relative performance.
Excellent. A couple year-end reminders: keep good track records, complete a year-end tax projection. That'll be super important. And by the way, we do think year-end capital gain distributions are going to be higher, maybe materially higher this year versus last year. So we want to take that into account. And make sure you process year-end charitable donations ASAP. I know we're still 2.5 months from year end, but we really don't like waiting till December 15th or 20th or even like 27th to process these, because we just can't commit that they'll get processed in time. And then just one other noteworthy item: Social Security has announced their COLA increase for 2025, and obviously much more muted than it had been the last couple of years. So let's now talk about estate and gift planning. And And I'm going to start kind of at a high level with estate taxes. And first, what are estate taxes? Well, basically, it's a tax imposed on the wealth transfer at death. Not everybody is subject to it, and we're going to explain why, but if you are subject to it, at least on a federal basis, it can be very costly. The maximum estate tax rate right now is 40%. But why doesn't not everyone get exposed to estate tax? Well, currently the federal exemption is 13.61 million per individual. So you have to have more than $13.6 million to be subject to this on a federal level. Or as a couple, it's $27 million. So, I mean, that's a big number. So a lot of people just simply don't have to worry about this. Now that exemption does increase a little bit each year. However, with the sunsetting of the tax law, and this is a big issue, that exemption is going from 13.61, or maybe a little higher, that it'll be in 2025, all the way down to around $7 million. Now, we don't know the exact amount because it's based on inflation the next year, but it's going to be about half. That's going to be a big change, and that is going to happen unless Congress acts. So it will take act of Congress and passage of new legislation in order to stop this from occurring. So that's a big deal. What's the gift tax? Because I just talked about the estate tax, but what's the gift tax? Well, it's a tax imposed on gifts made during lifetime to non-charities. However, a lot of people don't have to worry about this either because there's an $18,000 exclusion per person per recipient. So let's say you've got a child who's married and the mom and dad want a gift. Well, each parent can give $18,000 to the child. So that's $36,000. And they could actually gift that same amount to their in-law, the son or daughter-in-law. So there's another $36,000. Okay, so it's a pretty big number that you can gift annually without having to worry about the gift tax. You can also give an unlimited amount to educational institutions or to healthcare providers for the benefit of someone else. None of that's considered a gift. If you give more than the 18 though, you are supposed to file a gift tax return. And what happens? You don't pay a tax. We just reduce your exemption. And you notice that 13.61 million is the same amount as the estate exemption. That's because the gift tax and the estate tax is a unified tax. It's a unified tax. Now, there are states that have estate and gift taxes as well. Here's some states that have some form of an estate tax, including Minnesota. So Minnesota has a relatively high estate tax. Our exemption is only $3 million. Now we have no gift tax, but we do have the estate tax. And I put here that it's not portable. What does that mean? Well, on the federal basis, if one person doesn't use all their 13.6, they can give the excess to the surviving spouse to use. In Minnesota, if you don't use your whole 3 million, let's say you only use 1 million and 2 million's unused, you can't give that extra 2 million to your surviving spouse. Big deal, especially since that is a relatively small amount considering it includes all your assets, it includes life insurance, it includes pension, et cetera, et cetera. So what are some planning techniques? Well, first, if you have a large life insurance policy, especially if you're maybe just buying that policy, consider an irrevocable life insurance trust. That way, when you pass away, you don't actually own that life insurance, the trust does, so it's not part of your estate. Easy planning technique. Now, if you have an existing policy, there might be a gift that you have to report if you're transferring that existing policy into the ILET. That's something that you would have to talk to your advisor about. If you're married with joint assets over $6 million and you're a Minnesota resident, think about estate equalization. What does that mean? Well, instead of, let's say, the wife owning 5 million of the assets and the husband owning 1 million, if he passes away first, right, he's going to have 2 million of his exemption completely unused and lost. If they just simply each own 3 million, it doesn't matter which one of them passes first, they maximize their Minnesota exemption amount. That's estate equalization. Important, especially for Minnesota residents that have more than $6 million. Another technique, utilize a bypass trust. So first spouse passes away. Let's say that spouse has, I don't know, let's say $2 million. And their spouse, the surviving spouse, has, let's say, $2 million. Well, if the first spouse dies, gives all of their assets to their surviving spouse, there's actually no estate tax on that because we have an unlimited marital deduction. You can give your spouse as much as you want on your death. There's no estate tax. But now when your spouse dies, at least in Minnesota, the way it would work, the spouse dies, right? Now they have $4 million. Well, that's more than 3 million. So they're going to have an estate tax. We can bypass that using a special type of trust. When the first spouse dies, they don't give it directly to the surviving spouse. They put it into a trust for the benefit of the surviving spouse. Easy way to avoid some estate taxes. The other thing I always talk to clients about when we discuss estate and gift tax planning, and I'm sure you do as well, Jonathan, and that's annual gifting. Like give to your kids $18,000. It's a great estate planning technique. 529s, you got grandkids, really, really good technique because you can front load 5 years worth of annual gifts into a 529 plan. Supercharge that 529 for education for the kids or in some cases grandkids. And then let's talk about estates that are particularly large. Let's say in excess of 7 million, maybe, you know, in excess of 14, 20, 30 million. We have a unique period here where those estates may want to consider really large one-time gifts in 2025, maybe 24, but 2025. And that gift would be somewhere between 7 and 14 million. Why? Well, I said the 14 million exemption is going to be going down to 7. The IRS said, hey, if I give a gift during my lifetime and it's, let's say $14 million, use up all my exemption today, and the exemption all of a sudden becomes 7 million in the future, they're not going to claw back that difference. So you get to take advantage of higher amounts today. Really, really great strategy for those that have very large estates. The only thing I would remind everyone, when you're gifting assets, this is for everyone, you get a carryover basis. That's not necessarily a great thing. If I got a lot of highly appreciated assets and I all of a sudden gift them to my kids, let's say I'm, I don't know, 85 years old. Now my kids get this carryover basis. They sell the asset. They have to pay taxes on all those appreciated amounts. If you just waited to gift that money, and let's say, you know, heaven forbid, but, you know, 85, maybe you got 5-year, 10-year kind of life expectancy, those assets would get a step up in basis if you kept them in your estate. The kids would never have to pay any taxes on the appreciation. So things to keep in mind, to think about. Of course, all these techniques you can talk to your SilverOak advisor about. We're all well versed in the various strategies. And of course, if you have any questions regarding today's webinar, feel free to reach out to your advisor, or if you have topics. Otherwise, you can reach out to me directly. Again, my number is 952-896-5701. So Jonathan, I want to thank you again for all the information, the rest of the team, and thank everyone that participated in today's webinar. We appreciate it.
Thank you, everyone.